Hey, what's up guys? It's Jakob here from TradeVibe, and in this video I'm going to go in depth about the lot size, how to understand that, the take profit, the stop loss, the ups, the downs of the market, the buy, the sell buttons, all that stuff. So if you're familiar with these terms I just mentioned, then this video is probably not for you. Then you can just proceed to the course or just proceed trading and go on with your day. But if you are new to Forex, then this might be suitable for you. I'm going to try and explain it as simple as possible so I don't overwhelm anyone, but just keep in mind, guys, it's normal if you feel a little bit overwhelmed, if there's too much information. Just remember, we have a support team. You can always reach out and we will help you with any question you may have. So like I said before, I'm going to try and keep it simple. And yeah, let's just get started with the video. So we're going to stay on EURUSD because this is a lot easier since we've already went over EURUSD on the other videos, and we're going to go with a long trade here. But before we do that, I want to explain a little bit about what you're looking at, because this is an app called TradingView, and this is the app that mostly traders are using. Me, Matt Nadim, would be using this app to make analysis, and then we would head over to our MetaTrader platform to execute the trade that you would then be notified about in Discord. But what you're looking at right now is the euro versus the dollar. And because the euro comes before the dollar, that means that in this case, the market is going up when the strength of the euro is increasing, and then the market is going down when the strength of the dollar is increasing. So basically, when the dollar is getting weaker, usually then the EURUSD would go up. And then if the dollar is getting stronger, then the EURUSD would go down. And if the dollar is getting weaker, that means that we can purchase more dollars with our euros per the price is increasing. So as you can see here, it means that how many dollars can I buy from my euros? So I have €1. It gives me $1 and 1.06726, I believe. My eyes can't see that far. But that is basically how to understand this rate. It is simply the exchange rate between the euro and the dollar. All right, are you still with me? All right, are you still with me? Because I know it can sound crazy, but so if you go to your Vantage and you say EURUSD, and you see down below there's a sell and a buy. Most people who just started out trading would probably think that the sell button means that you are closing your current trade that you have open. It's not. It is basically going the opposite of the market that's currently, in this case, the EURUSD. So if you are selling, it means that the market is going down. If you're buying, it means the market is going up. And the way to understand how you can profit from the market going down is just to imagine the EURUSD reversing. So instead, when you are selling, you're basically just doing USD, euro, instead of EURUSD, because obviously in order to make money, we need something to go up. But instead of having to reverse the chart to USD euro, which I can easily do here, because if you notice, look at the market here going down on the EURUSD. But if I went to the USD, you would see it reversed because the price is just reversed. So now you can buy this many dollars for, this many euros for your dollar. It's lower because the euro is more worth. And so instead of having to always go and buy when you want to sell, okay, it's going to become a little bit complicated here, guys, but I hope you're with me. So instead of having to reverse the pair, you will literally just reverse it on the same pair by going in the opposite direction. You're basically just exchanging dollars for euro instead of euro for dollars. Does that make sense? If not, then it is fine. If you don't understand it, you can still just sell the market when we tell you to sell and buy the market when we tell you to buy. But now let's just get back here to the EURUSD on the 4 hour. This is 4 hour candles. So what you're looking at right now is a period in the market where all of these red and green candles represents right now 4 hours each. So the volume can be different in price depending on the period. You can see here we had April 18th at 11, and then the next candle would open up at 3 p.m. on the same day, and then you would have another 4 hours in here and then another 4 hours, and that is pretty much how to understand this. So if we are to open a trade on this as we did before, we could do a long position here, and let's say we want to go with 50 pips. And there we go. And we want to go with 50 pip stop loss. All right, so as you can see right now, we have 50 pips here and 50 pips right here. And the price of the stop loss has a price and pips, and the take profit has a price right here and pips. It's the same on our Discord. We will tell you a certain price where the take profit is and a certain price where the stop loss is, and then also make it a little bit easier to understand, then put in the pips. Now, you have an account, I have an account, and whatever profit you are making here from here up to here is depending on your volume, aka your lot size. And the same goes for down below as well. It varies depending on your trading size. But let's just go with $1,000, and I'll take my phone here and we can open up a buy. That is what we're looking for right now on the USD. So the volume, as we talked about before, I can give you an idea of how to understand volume a little bit better. Volume is the money you're exchanging, and it's a lot more money than your own money. And the reason for that is because the market on a day-to-day basis are not moving that much. So if you are using your own balance only to exchange to another dollar or another currency, then your gain will be insignificant unless you have a lot of money. That is why the broker comes into the picture. They lend you the money for you to trade on, but you put your own capital at risk before their capital, and they will close the position before their capital is at risk. Now, it sounds a little bit advanced. The way to understand this is just to make sure that your volume doesn't exceed your tolerance of risk, because your risk tolerance is what makes you sustainable long-term in Forex, because you should always respect it, and you shouldn't drag or do higher risk than normal because you get greedy. It's important to remain disciplined towards your tolerance. And if your tolerance is 1% of your balance, then you need to respect that. If it's 5%, respect it. I would never recommend anyone to do more than 10% of their balance in one trade. You really have to have a good edge in the market in order to do 10%, but I would recommend to do about 5% risk at max. Now, as we've done before in previous videos, I showed you how this looks like. But in order for you to understand how much you're risking, you need to understand your stop loss. And the stop loss in this case on the video, as we've talked about before, is 50 pips. And so because of that, we're going to put in 500 points here. And now, as you can see, our volume is 0.01 lots. That is currently only $5 of risk. So if we add up this to 0.02, you will now see that it is the double, and then again it's another, and then again it's another $5 that's keeping on being added. Now, if I increased my stop loss another time, our stop loss is now 100 pips. Therefore, we are risking $40 on the same volume as before. And that is basically, if you go here, it would mean that our stop loss is now all the way down here, which now means that you could potentially lose more than you could win. Now, we told you in this case that your stop loss shouldn't be more than 50. So you shouldn't have a bigger stop loss. You also shouldn't have a smaller stop loss, because if you get taken out in a trade because your stop loss was here instead at this level and ours were down here, and then the trade reversed and went into profit, you could have lost out on that opportunity, which would really suck, because obviously everyone want a profit. So remain the stop loss at the same level as us, and you should be good. Now we need to go back here with the stop loss. So what we could do is just quickly reset this. As you can see now, it will put back in 50 pips, aka 500 points. And then in this case, we want to risk a little bit more. So obviously we'll increase this. As you can see here, you need to do a little bit of math here. Otherwise, you can also have an app that can tell you the percentage. But just keep in mind, this is $1,000. So 10% is $100 at risk, where 5% will be 50. So I can just keep on increasing my volume here until I reach 50. And as you can see, I reached 50 about here. And therefore now I know that in order to do this trade you see right here, I would need to put in 0.11 lots on this stop loss. That means that if the price goes from here down to here, that's 50 pips. I mean $50, which is also 50 pips. Now, If we open a trade with 0.11 lots and the trade just keeps on flying and you're like, okay, I actually want it to go a little bit higher, that's on your own risk. If we don't tell you to do that and you for some reason want to increase your take profit and it never hits it, but then it goes back down, it's on you. We will tell you if we increase our take profit or if we decrease, we would never increase our stop loss. If our stop loss is here, it can only go up for the future of the trade. We would never drag it further down, and we will never recommend you to drag it even further down yourself. Our stop loss has been put based on market structure and analysis that has determined that this is the appropriate place to put it. So you should not be moving it further down. All right, I cannot stress that enough because I've heard about a bunch of people, including myself when I started out, that the price is getting near your stop loss and people are afraid of losing, so they keep dragging it down. But now what happens, let's say that we updated you with the trade and say, guys, move your take profit 50 pips more up. Then in this case, it would be at around here. Then what would happen is that instead of only making $50, you will be making $100 because your volume is the same. Therefore, the double the amount of pips is double the amount of profit. So in this case, earning $100 with a $1,000 balance would mean that you have now earned 10%. That is a risk to reward of 2, meaning that you overall only risked 50, but you potentially gained 100. So you gained more than you could lose. So we can put that in here. We'll put in, there you go. As you can see here, 100 pips is about $100. So we can just click the buy and we can now update this and we can see the trade is running. And that is pretty much how to understand the ratio between your stop loss and your take profit. And then you just need to wait for the market to basically hit your take profit or hit your stop loss. Overall, like statistically wise, we are hitting more take profits than stop losses. And as long as you follow that with us, then you should also be good to go. All right, guys, that's it for this video. I hope you liked it. I hope you are now a little bit smarter in terms of how take profit, stop losses, and volume works. We will be covering much more in detail how this works overall in the course. We're going to be talking a little bit more about leverage, how that works, the margin percent, and equity, what that means, and the free margin, all those things. It's something that I recommend anyone to understand, because if you understand these terms, you can become a true master of risk management, which I believe is important. But for now, this is all you need to know in order to get started trading with TradeVibe. I hope you enjoyed it, and I will see you.